All right. Well, good morning, everybody. I hope everybody's having a great day. Welcome to another edition of Money Maxi, where we're going to talk about all things money. It's your boy, Brewster on the mic. All right, guys. Well, let me get everything situated. You know what, man? You know, I just noticed I didn't even announce that I was going to do this. I just realized I didn't even put it on the Discord yet. But you guys already know. I already said this on the live stream. I know right now, like, I just started out, so there's not a lot of people watching. But yeah, to the 3 or 4 people watching, I do appreciate you. I do appreciate you. But yeah, I need to put it on the Discord. I need to start announcing it. But regardless of whether or not I announce it, you guys already know every Monday and every Thursday at 7 a.m. I'm going to get up and I'm going to do these Money Maxi live streams. So hopefully you guys are able to join in. And participate going forward so that, we can have us, a good time and maybe even answer like a couple of questions for you guys. Because I know some of you guys have some questions. Guys, if you want to ask me a live question about finances, whether it's like personal finances, trading, economics, what you see on the news, like anything like that, you guys are always welcome to come by in the Discord. The Discord link is in every social that you are seeing this live stream. So if you're watching this live stream right now, there should be like an about section and there's a link. It's a link to the Key Crew Discord, lock in, breakout. That's what the Key Crew is all about. So anyway, guys, come through. You can come through into the live voice chat and ask me live questions, or you could just DM me the question and I will answer that for you guys. But yeah, let me just announce it in the Discord that I am live. We are live for another Money Maxi. Yeah, Money Maxi. Because, yeah, this show, man, it's all about, this is all about, it's all about maximizing returns, okay? And that's going to mean something different for everybody. Okay, everybody's gonna have a different idea of what that really means. Okay, and actually, one of the things that I wanted to go over today was actually something that we went over last time on Money Maxi. So last time I said I was gonna put a retirement calculator link in the live recording. I did not do that. Okay, I did not do that. And there's purposely why? Because right after the live stream, I actually got a question from a live audience member. I guess they just didn't get their question in time, like during the live stream, but they got a question in afterwards, and it kind of got me thinking. Because I understand that for some people, they might not be able to invest a lot of money like at once, right? So they're putting little bits of money at a time. And one dude's valid, like I'll tell you right now, I think it was like if we put $2,500 away for like something years, 65, I think that was the example. It's like 47 years or something like that at like 6%. And the 6% is the rate of return that we used. And the reason why we use a 6% return is because on average, all right, the S&P 500 does anywhere from like 6 to 7 to 8. I mean, the reason why it's such a range is because depending on what year you start investing in, that's going to change, right? Because, for example, like in your first year, if you invest, if it's like an up year, and then you have like little small down years, like an after that, and then you have more up years, like 3 or 4 in a row or something like that, obviously your rate of return, your average is going to be a lot higher than somebody who starts on a bad year, right? So that's why it kind of like ranges. But you could safely say on conservative basis, the stock market usually does an average of a 7 to 8% per year. And last Thursday, when we were actually doing the modeling, I said 6% because I just wanted to be conservative. I didn't want to give people like all these like wild ideas that they're going to get rich overnight. All right. And so I purposely reduced the kind of target rate of return, just so like, we could be like a little bit more sensible, a little bit more conservative, because, if we account for like really, really bad years and we assume that returns are going to be really, really bad, if returns end up being more normal or even better, that's just icing on the cake, right? So as far as like financial planning is concerned, I always like to show a lower hypothetical rate of return, just so like we're all like, so we get the most conservative outlook. Okay. Now achieving 6% per year, it really is not all that difficult, to be honest. To be really honest, it's not all that difficult. Okay. And again, the S&P 500 on average on a 10 to 20 year basis does around 7 to 8% per year on average. I mean, you don't have to take my word for it. I mean, you can actually go on like TradingView or any type of like stock charting software or website, and you can see like, yeah, on average, the stock market tends to go up. I mean, if you look at any like multi-decade time frame going all the way back, I mean, it's generally, the stock market goes up, okay? Because productivity gains, the population, the workforce, they all move up, and more people have to invest in the stock market for the 401ks and things like that. So that's why there's always this like, like a long-term upward drift. Okay. And if you look at the past like 100 years, corporate America has been one of the safest places to really invest for the long term. Okay. But anyway, let's go back to this. Okay. So yeah. So we said like, okay, if you were to invest $2,500 a year, that's like $200 a month, right? And you did this all for like, you did this from 18. Actually, you know what it was from 30. Right. I said, if you're a 30-year-old, and we'd said, if you're a 30-year-old and you save for like 35 years, you get like a 6% rate of return, and you put $2,500 away. By the time it's all said and done, after about 35 years or so, you're going to have about $278,000. Okay. Now, $278,000, but in that same time frame, you only put about like what, 70, 80,000? Like something like that, $80,000 or $90,000. Like if you take all these $2,500 and you add them all up times 35, actually, let's just do some quick math here on the calculator. Let me just pull up my calculator real quick. So I know it's too early in the morning for me to do mental math. So 35 times 2,500. Yeah, so that's $87,500. So in 35 years, you would have put $87,500 into this, like, let's say retirement account or whatever it is. And over 35 years, you at a 6% rate of return, at the end of it all, you'd have about $278,000, right? Now, is this better than nothing? Yes. I mean, this is way better than you like having nothing, right? So that's why this is way better than just having no plan at all. But is this going to move you up a social class? Like, if you're middle class, is this going to make you rich? No. All right. If you're poor, is this going to make you middle class? I mean, maybe. But it definitely is not going to make you rich by doing this. Okay. You're not going to be poor. All right. And at least you're going to have $278,000. Now, $278,000 35 years from now is not going to be the same. Just to put it in like, averaging, like, let's say you're averaging about like 2% inflation, which like in today's world, like, I mean, right now, inflation rates are a lot higher, right? I mean, oil's going up. We've seen oil going up. If you've been to a gas station in the last week, like, you just realize, like, gas just went up like 20%, like, in the last week or so with this whole Iran situation. So, I mean, inflation is a little bit on the higher end right now. But, if you look at, like, 2008 till 2020, okay? So, right after the financial crisis all the way to, like, all the way to like 2020, like until COVID, inflation was actually like low for that 10-year period from 2008 to 2020, about 12-year period. The inflation rate was like 1.5%. So it averages out to be about between 2 and 3%. You can think of it as like this, okay? In 35 years, all right, every dollar is only going to buy about 50 cents worth of stuff in today's dollars terms, all right? And there's a little shortcut called the law of 72. All right. You take like a rate of return. Okay. So let's say 2% as inflation. Yeah. So if you divide 72 by 2, that is going to tell you how much time it's going to take to double. Okay, it's just a quick little mathematical hack. It's a little shortcut that you could use. Okay, it's called the law of 72. All right, so you take your interest, you take some type of rate of return or rate of inflation or whatever it may be. You take some sort of rate, you multiply it by the number of years that it will take to get to 72, and that's how many years it will take to double. Okay, so example. All right. Law of 72. Let's assume a 2% rate, a 2% rate of inflation. 72 divided by 2 is 36. That means in 36 years, at a 2% rate, things will double. Okay, so with inflation, things go in the opposite direction, right? Your money means less. So you could think of it as just a quick estimate. It's a very rough estimate, but you could think of your money goes down in value by half every 36 years. Okay. So in this example, right, from 30 to 65, it's almost 36 years. That $278,000 really is only going to buy you about $130,000 to $140,000 worth of today's stuff. Okay. That $278,000 is going to have the same purchasing power as today's $140,000. All right. So, so in that regard, you still made money, because you put $87,500 into this. And even in today's dollars terms, you're still getting about $140,000 out of it. Now, in nominal terms, you're getting that $278,000. But you see what I mean? It's not going to make you rich. All right. Doing it this way is not going to make you rich, but at least you're not going to be as poor. Right? You're not going to be as poor because you got that $278,000 saved up. All right. So I think, you have to keep this in mind. So if what you want to do is, if you really want to save up for your nest egg, if you really want to do this, all right, that means one of two things. Okay. Either you got to increase your contributions, or you need to increase the rate of return, or you need to start earlier. Meaning invest for more time, okay? Either retire later or invest earlier, or a combination of all three, okay? Now, for me, obviously, I think the best thing is to do all three. Try to increase your rate of return, increase the amount of savings, and increase the amount of time that you invest. Now, that's not reasonable for a lot of people. And especially for those of you who don't know how to invest or how to trade, increasing that rate of return can be extremely dangerous, because that means you're increasing the risk in your portfolio. So keep that in mind. It all sounds fine and dandy when you say it like that, oh yeah, we could just increase the rate of return, right? But it's not that simple. That means also you're increasing your risk that you put into the portfolio, right? Just to keep things in perspective, in this 35-year time span, if you're still saving $2,500, I mean, just every 1 point of return. So right now at 6% rate of return, you get $278,000, right? So if you increase this to 7, all right, at 1 extra percentage point, you see that we get some more money here, right? About $70,000. It's about $70,000 increase. Okay, if we get closer to the actual average stock market returns of about 8% per year, then you're looking at about $430,000. Now, if you're able to increase the rate of return as well as increase your contribution, so instead of only putting $2,500 away, you're able to do a lot more than that. Let's say $300 a month. Right? If you do $300 a month, then, even more money, $620,000, right? So, there's something and this is going to be different for everybody. So some people are going to be okay with learning how to trade, learning how to invest, and getting that extra, what we call alpha, the extra alpha, right? The alpha is, you can think of it like this. For anybody who hasn't heard of the term generating alpha, think of it like this. It's it's whatever benchmark or your current rate of return that you're making, and you making more than that. That difference, making that more, that's what we call alpha. So let's say the average stock market return is like, let's say 8%, right? And you're averaging like 10%. Your alpha on top of the benchmark US stock market is that extra 2% per year, right? So most people are not going to sit there and learn how to trade and invest to generate alpha, even though it is the best thing for them, even though it is in their best, even if it's in their best interest to do so, people won't. Okay, so let's be real. There's more to life than money. All right. From last time, I told you, money is just a tool, right? A lot of people don't want to like live for money. Like people just want to live their life. I get it. I 100% get it. You know, life is short. You want to spend it with your loved ones. You want to have fun, all this stuff. Most people find money really boring and all that stuff. But having said that, it is worth learning, especially if you're young. If you're like really young, if you're like in your 20s, I think any person in their 20s and even 30s, I think if you're in your 20s and 30s, you should learn how to trade and invest and generate extra alpha. If you're past 40, like mid 40s, if you're like in your 50s and stuff, I still think it's worth it. But just statistically speaking, you have just less time to really benefit from that alpha. But if you're in your 20s and 30s, you have every incentive. You have so much time ahead of you that it really makes no sense not to do it. Like you should learn how to trade. You should learn how to invest, generate that extra alpha. You really should. All right. If you're in your 20s and 30s. And it can make a huge difference. I mean, we just saw what happens, if you let's say like right here at $300 a month at 8% rate of return for 35 years, you're talking about at age 65, you're going to have $620,000 at 8%. Now, again, like let's say you're able to generate an extra 1 percentage point on top of that, right? That 620,000 all of a sudden becomes 776,000, right? Was it 620? Let me go back to 8. 620,000, one extra rate of return point, all right, for 35 years. That's 776. That's $150,000 difference in 35 years. All right. Now, for some of you, saving for 35 years seems like way too much. Like it's like way too long, right? Way too long. Okay. Let's break it down a little bit more digestible. Okay. Let's talk about just 5-year plans. Okay, let alone 30-year plans. Okay, I think you should plan 20, 30 years in advance, as much as possible. I mean, there's so many things that can change, right? But there's so many options available to you to save up for 20, 30 years. I mean, there's IRAs, 401ks, all this stuff. I mean, we can get into that more detail in further episodes and in later episodes. But for just for interest of today, let's keep it really simple. Let's keep it really simple. Let's talk about 5-year plan. Okay, let's talk about a 5-year plan. All right. So if you're let's say let's keep this really simple. Okay, let's just talk about like $100 a month. Okay, I know $100 a month. All right, if you wanted to save $100 a month, all right, and you were to make, let's go back to our conservative estimate, 6% rate of return for 5 years. Okay, that means for 5 years you're gonna put $1,200 away. That's $6,000 that you put into this. You're gonna have $6,700 in 5 years. Okay, in 5 years. All right, so you put 6,000, you're getting out 67.64. So you're making an extra $764 in 5 years at a 6% rate of return. All right. And I have a whole spreadsheet. And this time I will put this on there, but I just wanted to clarify all of this before I share it. All right. And I'm going to make a whole video just on this, like the importance of saving and investing. Okay. I'll make a whole nother video just from like little pieces of what I said last time and this time. And I'll just make like a 5 to 10 minute video on the importance of saving and what you can do to have more money at the end of this like target period. Okay. I'll make a whole separate video on it, and I'll make sure to put this. And again, I'll leave this spreadsheet free so that anybody can use it all for free. All right. So if you save $100 a month at 6%, you're going to have this much. Okay. So now let's say let's say you're on a fixed income and you just cannot contribute anymore. Let's say you're starting out, and also too, this is just a 5-year plan. Scale this at any age. Like you could be 18 and 5 years later it'd be 23. It's no difference. This number doesn't change anything. As long as it's the same number of years, it doesn't mean anything, right? 18 to 23, that's still 5 years to invest. 67, 64. See, no difference, right? Whether you save $100 a month as an 18-year-old or $100 a month as a 30-year-old, after 5 years, it's always going to be the same, right? The only way it changes is if you're 18 years old and you're like, well, I'm going to do this until I'm 65. Obviously, that's like almost 50 years that you're investing versus somebody who's 30 to 65. That's only 35 years for them. So a person who's got 18 years, the person who's got more years to save and invest, obviously, they're going to have better results, okay? But same time period for same time period, it's going to be the same. Whether, me investing $100 a month for 5 years is going to be the same when I'm 18 years old as I am 30 years old, right? From 30 to 35 or 18 to 23. It doesn't matter, right? So this is applicable to anybody. So let's say you were to invest for 5 years, you put it for 6%, $100 a month, and you cannot increase the amount that you put into it, right? You're going to have to generate more alpha. That means more rate of return. So let's say from 6%, you go to 8%. All right. All of a sudden, now that $6,700 that you have after 5 years, it's more like $7,000. Okay. Now, this is where trading and investing can really help you out. Okay. Let's say you're able to generate 25% per year. Okay. All of a sudden, that $6,700 at 6% is now 98, almost $10,000. Okay, you put $6,000 into this, you will get $10,000 out. Let's say you're really good at investing and you're able to generate 50% per year. You have $15,000. You're putting $100 a month for 5 years, putting $6,000 into this, but you're getting $15,000, almost $16,000 out. Now, again, increasing this alpha means you're going to put more risk in your portfolio. Okay, you're going to have to put some more risk in your portfolio, but that's the name of the game. The name of the game is you have to take calculated risks. All right, now if you don't want to do that, okay, if you don't want to mess with this rate of return, it just means you have to invest longer, invest more, all right, and just contribute more toward this plan, right? If you really wanted to make sure that you got more money out of it, you might have to invest a little bit more time. Like instead of 5 years, do 10 years. And if you want to keep that same rate of return at 7, like let's say 6%, all right, let's say 6%, you're gonna have to put for 10 years. After 10 years, you could double the time. All right. So if you were to invest this at 6%, at 10 years, it will take you double the amount of time to get the same amount of money, $15,800. Remember when I put 50% here, 50% for 5 years, right? At 23, what did we get? 15,825, right? But if you don't want to generate alpha, if you don't want to take those excess risks, and if you want to just stay to that conservative 6%, well, in that case, it's going to take you 10 years to get the same amount of money. And you're still going to have to contribute $100 a month every month for those 10 years, right? So this is the big difference between generating that alpha and not generating alpha. And this is why I keep telling people, if you're in your 20s and 30s, you really should learn how to trade and invest. I think you should learn how to trade and invest at all age groups, not just in your 20s and 30s, but I think especially those that are in their 20s and 30s, because you have so much time ahead of you that it's going to make a huge difference. Let's say you're 30 years old, okay? Let's say you're 30 years old and you're doing this till you're 65, okay? Okay, and you do the 6%. Yeah, you do the 6%, $100 a month, yeah? Okay, you're going to have $133,000 in 35 years. Is that going to make you rich? No, it's not going to make you rich, right? All right, now let's say you're able to generate a little bit more alpha. Let's say you're able to generate about 10% per year on average for that $100 a month. That $133,000 becomes $325,000. That's almost triple the amount Why? Because you're generating 4 points of extra gains, 4 extra percent every year, and it compounds for 35 years. That extra difference. That's a huge difference. All right, there's a huge difference. And this is why, if you're in your 20s and 30s, you really should learn how to trade. You should learn how to trade at all ages. You should learn how to trade and invest. I think everybody should learn how to do that. But especially if you're in your 20s and 30s or even younger, it's going to make a huge difference. I'm talking about 3 to 10x difference on what your retirement could look like. All right. It's going to make a huge difference. Now, having said that, you are increasing the risk. So there's the danger to that. Okay. Here's the danger to what I just said. A lot of people try to increase this rate of return and they get wrecked. They get royally wrecked. Why do they get wrecked? Because they put way too much risk into it and they start buying things that are just literally shit. Okay. They just buy shit stocks, shit coins, whatever it may be. They start taking way too much risk and they end up losing it. Right now, I'm not telling you that you need to get rich quick. All right. I'm not telling you that if you try to get rich quick, you will stay poor forever. All right. That's a really, really bad mindset, but you really should think about, maximizing your long-term rate of return so that especially if you're trying to move up economic classes. Like if you're in the middle class, like I'm assuming that most people that watch this live stream, because it is a finance thing, probably most of you are middle class. All right. Maybe some of you are at a different stage in your life where maybe you're making like minimum wage or something like that. Or maybe you're like in part-time work. Maybe you're a student or something like that. Or maybe you're just like, maybe you're in high school and you're still living with your parents, whatever it may be. All right. I'm assuming a lot of people are probably in that middle to lower economic classes. Maybe some of you are well off already, and maybe some of you are here just for the kind of like the investment thesis that I'm doing. Maybe you guys have a little bit. Maybe those guys have a little bit more money. But I know that if you're trying to move up economic classes, if you're trying to really get like wealthy, all right, and move up in economic classes, you're not going to be able to do that just by putting $100 a month at 6%. That is not how it works. So again, you can either increase your rate of return, but if you're not, for some people that may not be worth it. Okay. You can do 6%, but you may have to like increase the amount of money you put into it. So let's say your annual salary, you're able to generate like you get paid like 100,000. Okay. And out of that 100,000, maybe you're able to put $1,000 away. All right. If you put $1,000 away for 35 years, you're going to have $1.3 million at 6% rate of return. Okay. So again, there's many ways to get to your target. Okay. That's the point of all this. There's many ways to get to your target, and there's different things that you could use to your advantage. Again, the biggest variables here is how much are you contributing? Yeah. And how much are you contributing? How much money are you putting away and saving and investing? What's your rate of return, and how long do you let it grow? Those are the 3 biggest factors. Okay. And if you want to increase the amount that you get at that target time, you need to do something with those 3 variables. Either you need to increase the amount of time that you let it grow, or you increase the amount that you put in, which means you're increasing the amount that you invest, or you need to increase the rate of return, or do a combination of those 2 out of 3, or, something like that. Okay. So that is like the way of achieving your targets. Okay. So you have 3 main variables. Again, how long you let it grow and save, your rate of return, and also how much you put in and how much you invest. Okay. So those are your 3 biggest variables on all of this. So let's say like you're the type of person that's, what, man, you're like, Rooster, man, I'm not the type of person to be sitting there and making investment decisions. I just want like set and forget. And I just don't want to have to deal with all this. That's cool too. That's cool. This is not for everybody, like picking and choosing stocks and picking investment theses and building portfolios and monitoring a portfolio. Even though monitoring a long-term portfolio, you may have to place like 3 or 4 trades a year. For some people, that's just too much. That's too much attention for something that they just want to set and forget for 20, 30 years. That's fine. That's fine. But just know you may have to invest a little bit longer, and you may have to put a little bit more money into it. You may have to invest a little bit more, and it's doable. Okay. And again, at 6% per year, if you're 30 years old and you're saving this for 35 years and you're putting $1,000 a month into this, you could save a good amount of money, $1.3 million after 35 years. And again, you got to think about inflation though, okay? That $1.3 million 35 years from now is going to feel about like $650,000 in today's dollars terms, all right? Just from that earlier, what we talked about just like 15, 20 minutes ago about the law of 72, right? Take 72, divided by 2, it takes 36 years to double or half, right? So that's just like a little bit in a nutshell. If you really want to generate more alpha, you really got to mess with this rate of return. And and we talked about this last time, right? On last Thursday. I said there's a reason why, especially with the younger generation, that 18 to 30 crowd, there is a reason why they are the most likely to have done a crypto transaction. They're the most likely to have done at least 1 or 2 sports bets, and they're the most likely to have traded in stocks, right? There's a reason for that. It's because I think a lot of young people, especially in that age group, they know that just with a standard job, it's going to be really hard to make it just with a job. Okay, that advice that, millennials and any generation, millennial and prior, all that advice that people gave those people, like, oh, go to college, get a job, and you'll be fine in life. I think a lot of people are realizing that is not necessarily true. Okay, that is not necessarily true. A lot of people are going to get displaced. I mean, because of automation and all of this, I'm not trying to be sensationalist about AI. I mean, let's just face it. I mean, there's so much fake shit about AI that's out there. Let me tell you the reality. The reality is, automation is real, and more work can be done by automated systems. And so, but the thing is, it doesn't necessarily mean that those jobs are gone. It just means those jobs are different. It's just like, instead of like manual labor and very repetitive jobs, those jobs are going to get replaced by people that maintain those systems, right? It's like this. It's like when cars first, when automobiles got first invented. If you actually look at the newspapers back when automobiles were first coming around, a lot of people were worried, oh my God, the horse industry is going to collapse. Oh my God, look, there's going to be unemployment because all these people making horse carriages and raising horses, they're going to lose their jobs. Well, yeah, of course, the horse industry, they may have lost jobs, but guess what? Those jobs were replaced by vehicle manufacturing jobs, right? So it's the same thing. There's going to be a loss in jobs in certain things, but there's going to be gains in monitoring those systems or making those systems. Okay. But having said that, there's going to be, there's going to be a lot of people that, where that advice, just go to college and get a job, it's not going to work out for some people, for a lot of people. Okay. And I think this younger generation from 18 to 30, they know that. All right. And so that's why that demographic is the most likely to have traded stocks online. They're the most likely to have placed a sports bet gamble, and they're the most likely to have done a crypto transaction. All right. And it's because they're trying to generate extra alpha. All right. That extra return above what they could have done. All right. So that is a big topic amongst a lot of younger investors, is they're trying to generate that extra alpha. The danger, though, is that a lot of them get sucked into this narrative of, especially in the last couple of years, that whole meme coin craze, the meme stock craze. I mean, let's be real. No offense to anybody who bought GameStop a few years ago, but if you bought into that hype, if you thought that GameStop was going to be the be all end all, that was going to be your retirement plan, you got wrecked. You got wrecked, all right? You bought something you didn't understand, all right? That was like a social media phenomena that had nothing to do with the actual company, like fundamentals, right? Now, if you were able to time it right, get below like before all the mass hysteria, and you were able to get out at the top, more power to you. You probably made a lot of money, but most people did not. Most people ended up believing the story that, oh my God, GameStop is going to be this great company. And they bought at the top, and then they just as the stock came down, they held on to it thinking, oh, it's going to come back. And it never did. And they're just at total losses. I mean, we could take a look at the GameStop stock right now. I do not recommend buying this. This is a shit company. Okay, let's be real. This is a real shit company. But yeah, so, the whole GameStop craze was like, this stock was like a $2, $3, $4 stock and went all the way up to 120, right? All because of a social media influencer, the roaring kitty or whatever, right? But again, like, and that's the problem. It's like, that could be a problem because you're trying to generate this alpha. You're trying to make more money than what the market average is giving you, and you get sucked into buying something like this, right? So it does require, if you are going to be generating extra alpha and extra return for your portfolio, you will need to exercise patience and discipline. You really have to know what you're doing. This could be, I don't want to like scare anybody from not doing this. I do it myself. All right. And if you decide to generate extra alpha for you, your boy Rooster is going to be right here doing it alongside you. NFA, of course, none of this is financial advice. Okay. This is all entertainment and educational purposes only, but you will see me do it. And, you can either take from what I do and apply it to yourself. That's going to be on you, but I'm going to show you what I do to generate alpha. And if you guys want to be on the same page as that, that's cool. You don't have to. Again, I just told you, you don't have to generate extra alpha. You don't have to generate extra returns, but you will have to save longer. You will have to invest longer, and you will have to put more money away to hit your targets. All right. But for me, I'm going to invest for a long period of time. I'm going to put as much money I can into investment, and I'm going to generate as much alpha as possible. That's my choice. That's my choice. I'm going to maximize all three because I'm a money maxi. I live by what I preach. This show is called Money Maxi. I'm a money maxi. All right. I'm going to max out my money. That's just the way I'm going to do it. That may not be right for everybody. I'm just letting you know that's a personal choice that you're going to have to make. And that's something that you're going to have to really, really think to yourself and ponder. Is this right for me? Okay. I know it's right for me, but it may not be right for you. All right. So just think about it for a second before you start going all in on this. All right. All right. So that's that. I will put this this Excel spreadsheet in the description of the YouTube live video. Also, too, within the next couple of days, I will have the first long form video that I publish on why investing is important and all that stuff. Everything that I just listed out, in this with this spreadsheet, I will put it in a separate video. So it's like a 5 to 10 minute easily digestible video where I'll go over all of these concepts again, and you can always come back to that portion if you want to listen to that portion again. Okay, but yeah, so this show, Money Maxi, is all about, making these types of decisions and seeing hey, does this make sense? And how are we going to generate that extra alpha? Okay. And that is that's going to be the main thing about Money Maxi. But also along the way, we're going to be talking about just general finance topics too. So even if you're not somebody who wants to generate that extra alpha, you'll still have value out of some of the topics that we talked about. For example, last Thursday, we talked about the 1099 DAs from all the centralized exchanges and what you're going to have to report for any type of stable coin transactions you did. I know somebody in our community asked about that. I hope you were able to learn about what to do with your 1099 DA. There's a special form that you're going to have to fill out. I forgot what it's called. It's form 8949 or something like that for your cost basis. Anyway, more details on that last live video. If you go to all my live videos, it was the first ever Money Maxi. It's easy to find. It was last Thursday, and there's a section in there about 1099 DA. So these kind of things that we're going to be talking about as well too. All right. And we'll also talk about current events so that You can either use it for your own investment thesis and for your own alpha generation, or you can use it to sound smart in front of your friends, all right? Whatever it may be, okay? So, we'll talk about current events and also too what's going on in the world, and all the things that you see on Twitter will debunk a lot of myths and things like that. Again, that's what Money Maxxi is all about. And I'll do this every Monday and Thursday at 7 a.m. Eastern. Okay, so let's talk about some of the things that happened last week. So last week, guys, for those of you who are more like, I know there's like a big range of people that watch this or are part of our community, right? We got some people who are very new to money. They've never they are just learning why it's important to save, and they're just getting their feet wet, or their beak wet, I should say. They're just getting their beak wet. They're new. Some of you guys are like pros. Actually, we have some investment pros. We actually have like people from like these big banks, like professional money managers in our community as well too. So we got a big range of people. We got some professional money managers. We got some really like hardcore traders. We got people that are new, and we even got like some students. All right. So it's like we got a huge range of people here. All right. So for the more advanced crew, you guys saw on the Discord. Yeah. This is the part that, I try to be as honest as possible to the community, okay? Because I get it. Like, I'm not that type of guy that is going to say like, oh yeah, I win every trade. No. Far from it, okay? I have losing trades too. And I'm very honest about every single one of those, I make more than I lose. All right. And I mean, hopefully, that's the only way to generate alpha. You got to make more than you lose, right? So I make more than I lose, but I do have losing trades. All right. I do have losing trades. For those that don't, there's many ways to make money in trading. Some people think that you have to get over a 50% rate of correct trades in order to make money. I know a guy who only has a profitable trade 30% of the times, and he still makes money. It's because when he does make money, he makes more than all of his losses combined. Okay. Because he's going after these big moves. Yeah. But he's like, the hit rate is very, very low. But when he's wrong, he gets out immediately at a very, very small loss. So he'll take like 3 or 4 small losses to get that one big gain. That is possible. The math works out. Okay. You don't have to have this perfect hit rate in order to make money in the market. You could have a 30% hit rate. Only 30% of your trades make money, and you could still make money as long as you're making more than what you are losing. Okay. That's the most important thing. Right. It's math. All right. All of this is just math. The math has to work out. All right. It's not about storytelling. Trading and investing is rarely about storytelling. It's about math. Okay. So anyways, why am I getting into this? Because the Japanese yen trade, you know how we got long on the Japanese yen? So I got stopped out on this on Friday, and look at it. Now it's reversing. Great. All right. It is what it is. It does happen at times where we get stopped out, but we would have been right if we didn't, if we canceled the stop order. The thing about that is, and this is where mindset comes in. Like, you have to respect risk management. Okay. Yes. Like, you could tell nobody knows the future. And again, and this is what I said on Thursday. Nobody knows the future. I don't know. You don't know. Nobody knows the future. Okay. What if something bad happened over the weekend? What if this? What if that? But it could have went another way. I could have furthered my loss. Right. So again, you have to know before you enter a trade, always remember this. All right. You got to know your exit before you even start. You got to know your exit before you even start. So before you even start to trade, you got to know at what point do I leave? What's my take profit? What's my stop loss? And you have to respect it, okay? Because when you don't respect your stop loss, that one trade where it really goes against you and you don't respect your stop, that could be your last trade. If you lose all your money, that's your last trade. You just got fired from the market and that's it. Right? You have to protect your capital. Your number one job as a trader and as a capital deployer is you have to protect your money, because once your money is gone, that's it. You can't do anymore. Okay. So unfortunately, I did have to respect my stop. I can see now that the Japanese yen is reversing and actually going up now, which sucks because, if I had held it, I would have been able to make money on this, but it is what it is. A lot of things are reversing. So it looks like the stock market is actually coming up. Yeah, look at that. So This is the futures market. The stock, like the actual like US index is not open yet. Right now, it's 7:48 a.m. East Coast. So we got like a little bit less than 2 hours until the stock market opens. But there's something called the futures market. Okay. The futures market is like, you can think of it like the futures market was actually made for like commodities for future delivery. That's why they call it a futures contract. It's for a future delivery. So, let's say you were like a wheat farmer and you wanted to lock in the price of wheat while it was growing. And you could say, you know what? Next month is my wheat harvest. I will sell you my wheat for this price, deliverable next month. And that contract is traded on the exchanges. So the original futures contracts were commodities contracts like that. It was for commercial purposes that they did this. Now, the US stock index and most indexes, even treasury bonds, are now all traded via futures markets as well. There's a futures contract for US stocks, for bonds, for commodities, even for crypto. All right. So right now, so the futures market, the S&P 500 futures market trades almost 24/5, 24 hours, 5 days a week. It's not really 24 hours. There's like a 1 hour period between 5 p.m. Eastern and 6 p.m. Eastern while the exchanges like update their computers where it doesn't trade. But outside of that 1 hour, it trades 24/5. Okay. So in these futures markets, in U.S. East Coast time, they open on Sunday night at 6 p.m. Eastern because it's already Monday morning in Asia, right? So these are globally traded futures contracts. But anyway, the S&P 500's futures contract already in pre-market is up 0.75%, almost like, 0.75%. So we're already seeing that risk on. Over the weekend, we saw reports of some ships that were actually moving across they're actually moving across the Strait of Hormuz. There was one. There was the report on Saturday was that there was a sanctioned Indian tanker that was able to move across, and they had their GPS on at the same time. But apparently there was more. There was like an estimated around 14 or 15 boats and tankers that went through. It's still a fraction of what usually goes through. On average, before the war started, there was about 50 oil tankers that would pass by the Strait of Hormuz every day. Now, I mean, over the weekend, I think there was like 14 or 15 that went through. So, I think that report maybe is causing a little bit of risk on and maybe saying, hey, maybe people are thinking, that that things are de-escalating. Very possible. Very possible. It's very possible that that's true. Again, that's a story. Who knows, right? I mean, it could all change tomorrow. Nobody really knows. I mean, I don't know. You don't know. Nobody knows, right? Nobody knows what's going to happen. So, when it comes to like headline risk, what we call binary risk, because it could either be really good or really bad, right? So it's a binary risk. Anything like that, you got to be really careful. And this is where your patience and discipline is going to be the most important. This is where you really want to, be careful around like what you are buying and also your take profits and all that. This is where you really want to be disciplined, because if you have a trade and it goes in your favor and all it takes is one headline for you to lose out on that trade, you want to take your profits at disciplined places and take profits along the way. Yes, you're capping your gains, but you're holding on to those gains in case it reverses. And right now, with all this binary risk, anything can reverse immediately. All right. We saw that last week where oil and S&P 500 would have these huge rallies and then huge drops, huge rallies, huge drops, all based on headlines, right? And so that discipline is going to be even more important. If you see green, take green, all right? If you see profit, take that profit, all right? So that's why, you got to be very, very careful when it comes to that. Okay, just be very, very careful when it comes to this binary risk that we're seeing just from headlines. I want to show you that oil thing. I forget, there was like a post on here. Somebody was tracking. There was this guy that was tracking these boats across the Strait of Hormuz, and he was the one that reported. That's where I saw it, and that's when I did research, and I was like, he's actually like right about this. But I saw it on Twitter first. I forgot where it is. I forgot to save it. But yes, there was a report about a few tankers that were able to go through. Oh, here it is. I think here it is. Yeah. Oh, by the way, too, there was like a record inflow of oil from retail. I mean, could this be the top in oil right as retail gets in? I mean, I wouldn't be surprised. I mean, I don't know why retail's like that. The retail mania happens at the very end when all the dumb money comes in, all the smart money's already out. And I think this could be the top in oil. I mean, generally, when oil goes up like this because of geopolitical concerns, about 6 to 9 months later, it goes back down. I mean, we saw that with the Russia invasion of Ukraine. Oil went up for about like 4 or 5 months and then went back down into the 60s, right? So we could see something like that happen with this too. So, again, I can't tell the future, but, generally, this is what has happened before. So there's reports of tankers actually coming out and actually making their way to China and things like that. So that alleviates a lot of pressure. And let me actually see, where is oil at right now? Is oil actually coming down on that? So yeah, actually oil actually started up today. It actually went up all the way to $102. And as you can see in pre-market already, it is starting to come down. We're at $97. So already there's like a $5 range on oil today, which is huge. That's like a 5% range. It's very, very volatile trade. And again, if there's no trade in oil, I know some of you guys actually DM me. There was one DM in particular. I'm not going to name who it is. Somebody DM'd me over the weekend and said, hey, on Monday, can you go over your oil trade? And I was like, I don't have an oil trade. And they were like, well, don't you think it's an opportunity because of all this volatility in oil? I mean, yes, but that doesn't mean I need to take this. I mean, so again, mindset. There's always another trade around the corner. Why should I get involved in something where it's so volatile like this, where I have no idea which way the market's going to go on a day-to-day basis? All right. When you're trading oil, you're trading, and if you're trading oil futures, yeah. And, and the guy that DM'd me about this, he's actually a crypto guy, which means he's probably trading oil on a perpetual futures on a DEX, which means he's trading leveraged oil. So if you're trading on leverage, all right, if you're like doing like 20x, 30x leverage trades on oil, right? All it takes is like one day's move against you for you to get liquidated. All right, you will get liquidated if that happens. Yeah. So why do that? Especially when nobody knows which way oil is going to go. It's all based on binary risk. I mean, if you were to get in on oil, you should have got in before all this started. You should have got in when it was in the 60s, right here. Actually, in the Discord, we actually talked about getting in oil around like middle of February. We didn't get our price. We didn't get the dip that's far enough. I remember at that time we were saying like, oh, if it gets into like $57 or $58, we'll get long on oil, and it never happened. So we never got in on the trade, but that was a time to get involved. Getting involved now would be a fool's game. All right. Getting involved in oil now would be a fool's game. Okay. I mean, could it keep going up? Maybe. Could it go down? Maybe. But if you short it and it goes up a little bit, you could get liquidated, right? If you go long, but it comes down first and then goes back up, you could still get liquidated. So again, why be involved in this? Let's just exercise a little bit of JOMO, what I call JOMO, the joy of missing out, because there's always another opportunity around the corner. There's no reason to like jump on something that we don't have our edge. Okay. I'd rather just sit this one out and we get ready for the next trade. By the way, the next trade is going to be, I think is going to be EWZ. I mean, this is a trade that this is Brazil. This is the Brazil index ETF. So basically it's the Brazilian stock market in an index. Okay. Now we got long here at the Key Crew and all the guys that, on our Discord, we got long around June, July, August of last year around here. When EWZ was around $27 to $28. Right now it's at 35, 36. We are in long-term leaps. Let me show you. So this is actually, we are actually in call options on this. So let me actually show you. Yeah. Option chain. Yep. Let me actually show you like what I'm talking about. So we actually bought options on this, a call option. So call options for those for those of you who are not familiar with what call options are. Call options are just the right to buy. They're bullish bets on the market. Okay. So I use these derivative markets because it's kind of like leverage with like, it's leverage, but with defined risk. Defined risk means I know the worst case outcome. When you buy an option, the worst case outcome is that your option goes to zero. So there's no way for me to lose more than what I put into this trade. Okay. That's the whole reason why I buy options instead of using like futures contracts where it's just leveraged, because in a leveraged contract, and like a futures contract, you could actually potentially lose more than what you put in. Okay. Now that gets very, very technical. I know a lot of people here aren't like pro traders. You know, some of you guys are not like, you know, very into trading. So for the interest of this, you know, especially in the beginning while we're starting out, I'll try to keep the concepts as easy and digestible as possible. But right now, for some of you guys that are more advanced, yes, we have futures on this. You know, we do have this. The contract that I'm in is in this one. It's the 40 calls. We got in around $2, $1.80 to $2 a contract. We sold at around like we sold about half of them at like $5.50 after we bought it for $2, and then also too we sold 2 rounds of covered calls against it. So we generated income and we sold at a capital appreciation. I have about half the position still left. I am looking to buy more if this pulls back. If this pulls back, if EWZ pulls back to like $31 to $32, I'm going to buy more of these 40 calls. All right. And I've got over 2 years of expiration on this. And let's say like, so for example, like if EWZ goes to like $70 by the end of 2027, each one of these options is going to be $30 each. It's going to be whatever the current stock price is minus my strike at 40. So it's going to be $30 a piece. So it will have gone from $2 to $30. That's like what? 15x. All right. So this is the type of returns I'm looking at. This is my alpha generation right here. This is how I generate alpha. And I'm going to generate alpha using Brazil. All right. And that's just me. Like, and the reason why, you know, I've talked about like my thesis on Brazil, and I think we're still very, very early. Even though I got in at 28 and I took profits here at 37, 38, you know, I do think that it's very possible that we see Brazil come down to about $31, $32, okay? Even in bull market years, we have seen something like Brazil, which is an emerging market economy. We have seen their markets, even in bull market years, have these wicked pullbacks. I mean, we went over this on Thursday, but back in 2007, EWZ Brazil had a phenomenal year. All right. It actually did that year for 2007 to 2008. It did about like 70 to 80%. It had a 70 to 80% year, positive year, but that summer, the summer of that year, you actually saw a 30% decline over 2 months, but it came back and ended up positive 70% for the year. All right. It's just one of those things. That type of volatility is very common in a market like Brazil's. All right. So that's why I was like, you know what? If we get to our profit target, we're going to take profits. We're going to raise some cash, get some dry powder so that if we see that big pullback in Brazil, we got some dry powder to get back in at lower prices. Okay. So I am going to buy more of those 40 calls when we get to $31, $32. Now, if you guys are not well versed in options, and if you guys don't want to trade options, you can always just buy shares of EWZ, which there's nothing wrong with buying shares of this. If you bought shares at $28 and 36, that's still like 30, 40% you made. Oh, by the way, since you're a shareholder of EWZ, you also get their dividend. And by the way, right now, EWZ, the Brazil ETF dividend right now, it is a stellar 4.5% right now, I think. Yeah, it's about 4.5%. There's a 4.5% dividend right now being paid on Brazil. 4.6. All right. That is a tremendous dividend. Tremendous dividend. Just to keep things in perspective, right now, the S&P 500 pays like a 1% dividend. You're getting 4 times the dividend with Brazil over the U.S. markets. Anyway, food for thought. I think Brazil is going to be one of those economies that outperforms the United States for the next 1 or 2 years. And a lot of that has to deal with the capital migration thesis. All right. The thesis that a lot of this money that's parked in the U.S. is going to make its way to other markets around the world. Anyway, I do see a lot of people. Guys, I just want to remind everybody, if you've got a finance question, if you've got a question that you want to ask me about whether it's your personal finances, whether it's a trade, whether it's an investment thesis, you're always welcome to come to the Discord, go ahead on the VC and talk to me live, or you can DM me your questions and I'll answer that for you during the live stream. Mabu, I see you on the Twitch. What's going on, bro? It's good to see you, man. I know you usually see me playing games and stuff, but today we're doing our Money Maxxi live stream where we're talking about money, we're talking about trades and things like that. So I just gave people some updates on some of the trades that I took over on Friday. On Friday, we got stopped out of Japanese yen. It is what it is. I kind of wish I didn't. Oh man, look at this now. Now it's falling. Oh man, that would be nuts if Friday I got stopped out at the top. That would be nuts. Oh, that would be nuts. Anyway, it is what it is. Will I re-enter? No. After I get stopped out of a ticker, I don't look at that ticker for a week. It's just my own risk management. It's for my own mindset, for my own peace of mind. I just don't. I shouldn't even be looking at this because I shouldn't even be like tempted to get into this. But we are seeing the dollar coming down over the reports over the weekend that some oil tankers are making their way out of the Strait of Hormuz. Apparently, there are some back channel discussions between Iran and some of these other countries to allow certain boats to come through, which is actually alleviating some of that concerns about higher oil prices. So we're seeing oil coming down. We're seeing the dollar, which is a safe haven, also coming down. We're also seeing risk assets like Bitcoin, S&P 500, the NASDAQ. They're all going up. So, maybe that was the peak scare. Maybe it's already over. Maybe now it's like all being normalized again. It could be. It could be. So, and generally that's just how it works. Like these, unknowns become known. The biggest fear in the market is uncertainty. Big money hates uncertainty. And if there's a lot of uncertainty, prices can get very volatile. All right. Once that uncertainty gets priced in, once the unknown becomes known, then big money starts acting in the market again. Okay. So, and I think, if you just think about things in a long-term perspective, if you if you think about, if you just zoom out, right, this conflict lasted 3 weeks, 2 or 3 weeks. It is not like some long drawn out conflict, right? 2 or 3 weeks is not that long. Right. So, I think a lot of people, we're thinking like this is going to be the start of World War III. No, how many times has that happened in history, right? More often than not, it doesn't escalate like that. It doesn't. Actually, the fact that it escalated this far was surprising to most people. Most people that watch markets who have looked at modern history and things like that, the fact that it escalated to this point is actually like surprising. And usually it doesn't escalate this far, right? And usually these things de-escalate. So we're already starting to see that de-escalation being priced into the market with today's price action, I think. So already it looks like things are reversing. Yeah, look at the S&P 500 futures market. It's already up. We're already up above Friday's opening. Same thing with the NASDAQ. With crypto, I think crypto's working its way up. Woo, look at that. It's working its way up. Friday, we had the Friday prices go all the way up to 73,000, almost 74,000. It looks like the high of the day today already in pre-market has already been higher than that. So maybe we start seeing, maybe this is the bottom in Bitcoin. I think, for those of you who are like crypto traders, I think one of the things you got to be very cognizant about is that we did have a huge decline in Bitcoin. And generally, when you see a big decline like this in any type of risk asset, whether it's Bitcoin or not, it's very rarely is it a V-shaped recovery. Okay. Usually it will it could maybe go to like 80, 90,000, come back down, retest the lows, make a higher low, and then trend higher months later. It could be like that. It may not be like a straight V recovery, okay? And usually it's not. When it's like this big of a drawdown, it rarely is like that. 2022 was kind of like that too. 2022, see, it didn't recover V-shaped, and it actually made a new lower low, and it had to like stay there for a bit, accumulate, and then it came back up about a year later, right? So that could be the path. I don't know which path Bitcoin is going to take. Again, I don't know. You don't know. Nobody knows, okay? But if it were me and I went long here, and I've been DCAing, I would want to be taking profits all on the way up, because just in case if it comes back down, makes a new lower low, I don't want to be holding the bag and holding on to a loss like that, okay? I want to get at least my principal out. I at least want to get some gains locked in and maybe have a bag running just in case. So, liquidate, get my initials out, all right? Get my principal back, maybe lock in a few gains, and maybe with a small portion, I can ride it out just in case if it is a V-shape, or, what if I'm wrong? And what if this is a V-shape recovery? Well, I want some skin in the game, right? So I might, so what I'm going to do is once it gets to like 80, 90,000, I'm going to start taking profits on most of my position, and I'm going to leave a small position running just in case if it does become a V-shaped recovery. If not, it goes back down. I still have most of my money out in stables and cash, and I'm ready to buy back in at lower prices and take advantage of volatility if it were to present itself. So again, risk management. We are not paid as traders or investors. We are not paid to tell the future. We are paid to manage risk in the face of uncertainty. Always remember that. All right. So that is what I'm going to be looking at to do. All the crypto that I've accumulated here, I'm going to be trying to get out of them, or at least start taking some profits at 80 to 90,000. There's some other coins that we were looking at from before too that are doing actually quite well. And this is not for everybody. I know for some of you guys really hate crypto. It is what it is. I trade crypto a little bit. I have a portion, not a big portion, but a small portion of my net worth in crypto. And one of the coins that I've been accumulating is this thing called Ethi. I am not paid by them. I am not their shiller. I am not part of the team. Nothing like that. It is just a coin that I've researched, and I think it's going to be a good one to have. And this is it's a virtual token. It's a token that's on Base. That's part of the Virtuals AI agent ecosystem. Ethi has their own agentic AI agent. Basically AI agents that you can utilize for automated trading. All right, and Ethi is actually one of those protocols that generates revenue. I think it's one of the top revenue generators out of the virtual ecosystem. They have proven revenue, and they actually buy back and burn tokens with the revenue they generate. So for me, that was a huge selling point for this. Their user growth is actually going up even during these bad times, even during the crypto downturn. Their activity, their volume of usage of their AI agents actually went up. So more and more users are using them. Also, too, they're integrated with the Base app, and when you copy trade on the Base app, you're actually using Ethi's AI agents to do that. So they're fully integrated into the Base app, and so they're generating revenue from that too. So I think this is a great play. I'm in it myself. I've been DCAing between 1.5 million to 1.8 mil market caps. So I think I'm right at around break even. I think my break even price is like 1.62 million or something like that. So I'm like a little bit down, but almost break even on this. But I do think that this could go up, and maybe we might see some new all-time highs on this. And again, I'm going to start taking profits on this once I see Bitcoin going to like 80, 90,000. Because if Bitcoin goes to 80, 80, 90,000, I'm sure like some of these tokens are going to do very well. So, if this starts turning up and Bitcoin is around 80,000, I'm going to start taking some profits, taking my initials on all this and setting myself up for just in case if there's a big downturn, I don't know, Trump says something or he sends another rocket or somebody sends a rocket or this and that, I can take advantage of that. Okay. So that's something that I want to definitely be taking profits along the way. I don't want to be holding the bag just in case if everything reverses and comes back down again because of a headline. All right. That's a bad psychology. I don't want to be holding on to losses, even if I know that in the end they're going to come back. Right. It just takes a huge psychological toll on you. And that's what nobody is going to tell you about. Like when it comes to money, everybody here's the thing about money. All right. Here's the thing about money. When most people talk about money, man, and when most people talk about trading, the number one thing everybody talks about is like indicators, lines on a chart, golden cross, death cross, moving averages, this and that. Those things come and go. Okay? Those things really just come and go. All right? It's really about your mindset. Like patience and discipline and just having that mindset. I know people who don't know anything about indicators, and those things are very easy to learn, but they got the right mindset. And really, it is all about mindset. I know, like, there's some influencers that are out there. They're all crazy, and they're like, no, go for it. Like, go 100% in. Risk management, be damned, and all that. That's stupid. All right, that is how you stay poor forever. All right, the mindset is so important in this. And the thing is, holding on to a loss for that long, it takes a huge toll on your mind, man. And it makes you do stupid things. Like your biggest enemy when it comes to trading is yourself. 1,000%, man. It's yourself. You're going to want to do something dumb. If you're like facing a huge drawdown, you're going to be like, oh man, I got to make up that loss. And you're going to start doing some crazy shit. I have even seen professionals do this, man. Like I've seen professionals do this. I knew a guy, he used to be a floor trader. All right. He's a little bit older than I was. At the time he was 40. When I was when I was like young 20s, he must have been like mid 40s. All right. He was like almost 2 decades older than me. So, and he was part of the floor. He was a floor trader. He was a member of the floor. All right. So we're talking real pro here. Yeah. But then, electronic trading took over all this stuff. So, he wasn't a floor trader anymore. He did it all electronically, yada, yada, yada. Right. But even he fell into that trap. He tried to dig his way out of a loss and he overtraded and he ended up losing everything. And this guy, multi-decade experience as a floor trader, ended up having to go get another job. Guess what? He actually ended up driving for Uber. Nothing wrong with that. There's nothing wrong with driving for Uber. But again, from where he came from, he was a floor trader and he knew what the right thing to do was, man. He's a professional. Of course he knows. But his mindset, he had one trade that made him slip. And that's really all it takes. If you slip, if your mindset just slips once like that, it could be the end of your trading career. All right? That mindset, that one lapse in mindset is what did him over. All right? He took way too much risk. He went all in on something because he was trying to dig himself out. And the thing is, it was a significant amount of money. If he had just taken the loss and moved on and just stayed disciplined, he would have been fine. But it was just like that one lapse and judge me. And you know what the thing is? Like every experienced trader has been there. I've been there. I've done that before. I've done that many times before. Okay. Believe me, I've made the same mistakes many, many times. And you talk to any real trader, they will have made that mistake at least once. But I'm just saying, like that mindset, like really, like, and the thing is, you don't have to learn it by experience. You can just learn it from learning it from me. Like I'm telling you, don't do that. Like this is what it's gonna look like. Like that lapse in mindset. It's because you're gonna think it's the right thing to do, but it's not. It's not. All right. There's no certainty. Or there's no such thing as certainty. Nobody knows the future. I don't know. You don't know. Nobody knows. That patience and discipline, managing risk in face of uncertainty, that is what keeps you in the game. Okay? So don't be like him. I mean, again, even pros can fall into that trap. So don't fall for that trap, okay? If you have a loss, take a small loss. There's a saying, your first loss is your best loss. Okay, your first loss is your best loss. Why? Your first loss, you stop. Okay, you stop, you reassess, and then you fix the problem, and then you move on. Okay, don't let it fester and cause bad anxiety. Kind of like how Japanese yen right now is giving me anxiety, because if I had kept it, I would have done well. And even right now, I'm kind of like fighting the urge to get back into the trade. I really am. I'm really fighting the urge right now to get back into this trade, because what if I do get back into this? What if I do get back into the Japanese yen trade and this thing like reverses and just, this is USD JPY. So USD JPY, this going up means Japanese yen is coming down. When this is going down, it means Japanese yen is going up, because it's the US dollar Japanese yen pair, not yen dollar pair. This is the dollar yen pair. So how it's quoted on Forex, you go, so when you say long USD JPY, you're longing the first ticker and you're shorting the second ticker. If you say short USD JPY, you're shorting the dollar going long the JPY. Okay, so it's like an inverse thing. Why do they do that for the yen? I don't know. Every other currency like euro, British pound, they always quote it as euro dollar or pound dollar. For the yen, why do they do dollar yen? I don't know. It's just convention. I really don't know why they did it the opposite order for the yen. Maybe it's because the yen, there's so many yen in a dollar. Maybe that's the reason why. I have no idea. But anyway, I'm fighting the urge right now to get back into the yen trade, because son of a bitch. Anyway, I can't. I gotta stop looking at this, or it's gonna mess with my mindset. Anyway, we also have Alibaba. We still have that position where I'm in a drawdown for Alibaba as well, but I think this will come back. I mean, this is the drawdown on this. This was a smaller position. Remember how we made 2 Alibaba trades and we did really, really well, and we only put like a small percentage of the second win in a third trade for Alibaba. So I'm not too worried if this goes to 0, because again, like I only use a small percentage of the wins of the second win that we had in Alibaba. So if it goes to 0, it is what it is. I mean, this is such a small position for me. I mean, it is what it is. I do think though, we still got another like 45 days left on that spread. So I'm not too worried about this. And for those of you who don't know what my Alibaba trade is, don't worry about it. If you don't know about it yet, don't worry about it. I mean, we'll have more trades coming out in the future. So this is that old trade that is still lingering around. As far as like markets are concerned, I think that's the biggest things I'm looking at. And again, like let's just focus is a superpower in a noisy world. Okay, I'm really focused on Brazil. Brazil is my biggest conviction for the next year or two. Brazil. All right, Brazil. Why Brazil? It's part of my it's part of the dollar devaluation and also capital migration thesis. We've been saying this since 2025. We've been saying this since early 2025, late 2024, that we're probably going to see money that's invested in the US make its way to other parts of the world. Since 2008, the US has been the #1 destination for capital globally. That is why our interest rates were at record lows during 2008. I mean, also partially is because of quantitative easing by the Fed. All right. But even outside of that, I mean, just a whole lot of money came into the United States. And that is why interest rates were so low between 2008 and 2020. The reason why is because there's so much money coming in, buying our treasury bonds, keeping our interest rates really, really low. And it also meant a lot more money came into our stock market as well. And we saw record valuations in our stock market here in the US. Now, our stock market is very overvalued compared to other countries. Right now, Brazil is cheap. It is super cheap. I mean, it could go up another 10, 20%, and it's still under fair value. All right. There's a lot of cheap markets out there. I mean, even Japan, that Japanese stock market is not, it has a lot of value in it. Hong Kong got a lot of value. Central and Eastern Europe, lots of value in there. Although Eastern Europe, I don't know if I would ever invest in Eastern Europe, but but for the earnings, I mean, it's very, very cheap. And right now, the U.S. market compared to but when you actually like look at earnings, it is actually a little bit overvalued. So having said that, I mean, does that mean the U.S. stock market is going to come down like and crash? No, by no means. It could be flat for a few years and earnings go up. It could be like earnings coming up and then the stock market stays flat and earnings catches up to valuation. We call that a correction through time. There's two ways that that markets can correct. They can correct by price, which means that price actually comes down, or they can correct by time, meaning that the price goes sideways until the fundamentals catch up to the price. So it could be that the S&P 500 and the U.S. stock market just goes flat while the earnings comes up to match the valuation, right? It could be that. So by no means am I bearish on the U.S. stock market. Actually, my forever portfolio is at the S&P 500 index fund. My forever portfolio has a huge portion of it in the S&P 500, and I will never sell. All right. So only in the swing trading account and in the actively traded account that I have is where I'm going into like Brazil and buying and selling and things like that. But I do have a forever account that I don't touch, and most of that is in the S&P 500, and I'll never change that. I still believe in long-term U.S. I think in the next 10, 20 years, U.S. is going to be one of the best markets, and it always has been on a multi-decade time frame. But for the next year or two, though, I do think countries like Brazil are going to outperform. And with this new oil spike, I do think that the targets are a lot higher. So about a few months ago, I told you guys that my target price for end of 2027 for EWZ, which is the ETF for Brazil, I told you guys my target is anywhere from $65 to $70 per share by the end of 2027. If oil stays above this $90 to $100 phase, and if it just stays in this uptrend and like stays elevated for like a few months, or for a longer period, like for 6 to 9 months, if oil stays above $90 for 6 to 9 months, Brazil's ETF, this thing can easily get to $80, $90 a share by end of 2027. Because right now, most of the outperformance in EWZ is centered around Brazilian banks. Brazil also has really, really big energy companies. And if oil price sustains an uptrend, then those energy companies in Brazil are going to also start outperforming as well. So now you have Brazilian banks outperforming, and you got their energy companies outperforming. I mean, that's a win-win. Now, also too, Brazil is also a big exporter of soft goods and food commodities like grains, beef, and things like that. And those soft commodity companies are also doing extremely well. You add energy into that mix, I mean, that's going to be extra tailwinds for a country like Brazil. Brazil's just one of those countries, and I've told this, and especially after Trump came and I knew he was going to be all tariff trigger happy, I told you guys, Brazil's one of the safest places to put money because it is just one of those countries that is unsanctionable. It is really hard to put tariffs on a country like Brazil. Why? Because they have so many exports that are of value to a lot of countries. They export lots of food, grains, beef, metals, energy, all the things that lots of countries demand, okay? So when Trump put tariffs on Brazil in the summer of 2025, when he did that, after about 3 or 4 weeks, he reversed it. Because other countries came up to Brazil and said, hey, whatever you were going to sell to the U.S., we'll buy it and we'll give you concessions for it. So those tariffs didn't work. And then it drove up costs of coffee, fruits, all these things in the U.S. It just drove it way up. I remember during that summer, the Wall Street Journal was quoting coffee prices because coffee was just going way higher and higher and higher and higher. Orange juice as well too, fruits, bananas. All these prices were going way up, and I guess Trump was like had that moment. He had that taco moment. Trump always chickens out. He chickened out, and he basically reversed all of those tariffs on Brazil. And again, it's just one of those countries that's really hard to tariff because their exports are in such high demand. Okay, they have such high demand. Actually, I think Brazil just signed a trade agreement with all these Asian countries, China, India, Korea, Japan. They signed all these agreements agreements that were traditionally held with these countries with the U.S. So Brazil is now stepping in and kind of taking some of that trade kind of like business, from the U.S. So, I mean, okay. So anyway, that's my thesis on Brazil. I actually think this is going to be a really, really good performer for the next year or two. And again, I'm going to reload for a full position if this gets to $31 to $32. That's where I put more capital towards Brazil at $31 to $32 a share in EWZ. And again, you don't have to do what I do, and none of this is financial advice, but this is what I'm going to do. And you can do with that fact what you will, okay? 31 to 32, that's where I get buy more of those 40 calls for 2028 expiration, like I have, like what I showed you here. All right, I'm going to collect this. Now, again, if you are not familiar with options, you don't have to buy options. You can buy shares. You're still going to make a lot of money, and you're going to get a nice 4.5% dividend. You don't get paid a dividend if you own the option. You do get paid the dividend if you own shares. So there ain't nothing wrong with that. Ain't nothing wrong with making a good 2x and being paid 5% a year income for holding it. Okay, that's a very, very good trade, even if you get the shares of this. Okay, in my opinion. Okay, so EWZ, that is what I'm going to get involved. That is my biggest conviction play, and I think it's going to work out. But anyway, that's what I'm going to be doing. As far as like other trades, I mean, again, I went over crypto. I'm in ETH. I have some Pengu as well. I started getting Pengu. I started DCAing this around here. So this one has a little bit more to go up before I can start taking profits on this. I'd like to see it go to the 700, 800 mil market cap. Pengu is a meme coin. Yeah, I mean, I these days I don't like really getting involved in meme coins a lot. But the reason why Pengu I got involved was because, I mean, if crypto makes a comeback and meme coins do make a comeback, Pengu is probably going to be one of those that makes the biggest comebacks because it's just if you actually look at a lot of influencers who are not in crypto, some of them use like Pudgy Penguin, PFPs. They're not even like crypto people and they use it. They don't even know where it's from, but they use it. So it's got mind share. And also too, Pudgy Penguin's got a partnership with Walmart. If you notice, if you go to Walmart stores, some of the toys, you've seen these penguin toys. Yeah, that's a Pudgy Penguin. So they got an agreement with Walmart to distribute some of their toys in Walmart. Name me another meme coin project that got like a distribution deal with Walmart. Okay, there's none. Also too, if you look last year, Pudgy Penguin's representative was the mascot was there with an investment company. I forgot which investment company was. It was either Templeton or something like that. It was one of those investment companies. They were ringing the bell in the New York Stock Exchange, and a Pudgy Penguin was there. It was right there with it. So, oh no, it was God, no, it was one of those. It was one of those financial companies that has a Ethereum ETF. Oh man, my mind's going back. It was either Templeton or Jane Street or one of those. Anyway, they were ringing the bell at the New York Stock Exchange, and the Pudgy Penguin mascot was there ringing right next to it. Again, name me another crypto project mascot that has rang the bell at the New York Stock Exchange. It definitely has mind share. So that's why I put a little bit. So even if it goes to zero, man, I'm not too worried about it. I put such a little bit. It's like a lottery ticket. Okay, if it goes up, it goes up. If it doesn't, oh well. All right. So, oh wow, look at that. Bitcoin is moving on up. Look at that. Yay. All right. And oh God, I shouldn't be doing this. Oh my God. Look at that. I should have held it. Ah! All right. It is what it is. Okay. I'm already regretting getting out of this. Oh my goodness. Okay. So, I mean, things like this happen. You know, you're not going to win them all. So, again, that's why position sizing, risk management is always very, very important. My biggest position by far is EWZ. And again, this is my biggest conviction. I am, oh, wow, it's reversing all of its losses from Friday. Wow, it is like Brazil is making a huge comeback today. And so are a lot of stocks. I think a lot of stocks are making a huge comeback today. I think there's this kind of a risk-on sentiment now that there's some certainty around that Strait of Hormuz. But who knows? I mean, all it takes is like one more like bad headline, and this could all reverse. So again, I would really strongly recommend you guys exercise some risk management and just don't be going full ham on some of these trades. Okay. dollar cost in. Also, too, you see profit, take profit, okay? Manage that risk. Make sure you protect your capital, okay? That is most of the things that I had prepared. Let me see if there's any questions. I think I answered most of the questions that I got. I mean, somebody asked about like my thought on Bitcoin. So I answered all of that. Somebody asked me about, am I going to get rich off of doing, the savings plan? So that's why we went over that in the beginning. So yeah, I think I answered most of the questions. We only had like 2 or 3 questions over the weekend, but for next time, again, for Thursday, if you guys want to ask me some questions on what on any financial questions it may be, some of you, I know, for Thursday, some of you guys, we had a community member ask us like, what's the importance of saving and all this stuff. So it could be questions like that too. It could be very like general questions, general finance questions, or it could be specific about a trade. Whatever it may be, I will do my best to answer it. If I don't know the answer, I will find it. I will research it and find the best answer that I can find. I have not been stumped by a financial question, and in my years of doing this, I used to take questions like this on X Spaces as well. Never been stumped by one, but if I do ever get stumped by a question, hey, I can always do some research and get you a good answer for that. And, if you're able to, if it's a question that, that a lot of people are wondering about, it could be of great value. A lot of people could learn from those kinds of questions. So don't be shy about those questions. Bring them to my attention, and I'll try to answer that for you guys. All right. I see here, set trades. Hydra. Hydra. I've heard of Hydra. I don't know if that's what you're talking about, the Hydra network. I don't really know that much about it, to be honest. I've heard about it, but I don't know that much about it. I'm going to have to do research on that. See, there you go. You asked about it and I don't know. So I got to do some research. So I'll do research on Hydra. I'll let you know, what I think about it after I do some more research on it. And again, I've heard of it, but I just don't know as much to form an educated opinion about that. But the most important thing about all of this is, guys, manage risk. I mean, again, over the weekend, we had some positive news, but that doesn't mean that is going to last, okay? It could be that, right now is like, a little bit of like an alleviation, but volatility can come back. All right. Volatility can come back, and volatility can come and go in waves. Right now, the VIX contained. So there's something called the VIX. The VIX is the scare index. Okay. And also this VIX index is also traded on the futures market. There's something called contango and backwardation. So when the front month contract is higher than a later expiration, we call that a backwardation. Okay. That means that the closer dated price is higher than a later dated, right? Now, for those of you who don't understand futures and who don't understand calendar spread, don't worry about it, okay? There is a chart you can find this. It's the VX1 exclamation point minus VX2 exclamation point. Basically, it's saying front month minus the second month. Front month minus second month. That difference, if it's positive, we call that backwardation, okay? So whenever VIX is in backwardation, it means that there is a lot of short-term fear and uncertainty in the market, okay? A normal market is contango, where this number is negative, where VX1 exclamation, the front month minus the back month is negative, okay? Most of the time in a normal market, we are under this line. Only in periods of extreme fear do we get positive in this what we call a calendar spread of the VIX future. So if you look at 2020, for example, you can see in 2020, boom, during that COVID crisis, backwardation was almost 15 points. The front month was 15 points higher than the back month, okay? That's an extreme amount of fear, okay, in the market. So whenever we're above zero, whenever we're positive in this spread, front month minus back month, it means that there's a lot of short-term uncertainty. There's a lot of fear in the market. So whenever this is above zero, you have to think like, that means that there is always a chance of more volatility, okay? So it's still over zero right now, okay? And there's a very good possibility that this could actually go up for another wave of volatility, which means that we could see, the S&P 500 maybe come down a little bit, maybe starting maybe later this week into next week. It's just a possibility. I don't know, but I'm just saying, like, if you're going to get long, just take profits along the way, because you never know. It could all reverse overnight, okay? And those things are very, very common. Well, not very common. I should rephrase that. A sudden reversal is not uncommon when this spread is above zero. When it's above zero, sudden reversals are not uncommon. Okay. And again, everything is a probability. The probability of a big reversal is much higher when this number is over zero. It's still over zero right now. So again, if you're long, or if you have any positions and you see profit, start taking some profits. Be disciplined about it. Have a disciplined process to take profits along the way, because you could see big reversals and you don't want to be caught on the wrong side of a big reversal. Okay, guys? Just remember that, all right? Exercise good risk management. All right, guys. Well, in that case, that's all I had prepared. I want to thank you guys for joining in today. I see a lot of people on TikTok joining. Trader2, Teeter2, Trader, Little Zan. It is good to see you guys. Thank you for joining in today. And thanks for joining all of you guys out there. You could have been anywhere else in the world, but you decided to be here with me today. And I do appreciate that 1,000%. All right, guys, we will be back on Thursday at 7 a.m. Eastern, Mondays and Thursdays at 7 a.m. Eastern. We're going to do Money Maxis. And then for the rest of the week, hey, we'll play some games. We'll fuck around. We'll play games. Later tonight, I might be playing a little bit of Fortnite with the crew. So come through if you want to come by. If you want to join our squad and join our lobby, you can always do so. Discord link is in all the socials that you are seeing this on. Also, too, I'll be making some long form content on finances. And if you have any topics that you want me to cover in a live stream or in a video, let me know. I will take those suggestions. Anyway, guys, it was a pleasure being here with you guys. We'll be back on later today for some gaming. But for another episode of Money Maxi, we will be back on Thursday at 7 a.m. Eastern. Hope to see you guys then. Have a great day, guys. Peace.